Have you ever wondered how the world around you actually gets built? The wind farms quietly spinning on the horizon. The hospitals buildings where lives are saved. The highways you curse every Monday morning. The data centers humming day and night, storing everything from your holiday photos. The schools shaping future generations. Even the prisons, hopefully not part of your daily routine. Most people assume these infrastructures appear because governments click their fingers, a political promise, and voila. But reality? Reality is far more interesting and significantly more complex. Behind every infrastructure, there's a world of contracts, risks, financings, negotiations, bankers, lawyers, investors, financial models. This world has a name: project finance, a discipline where millions, or even billions, are mobilized by banks, private companies, or investment funds, with risks meticulously sliced and shared, an infrastructure built not by chance, but by design. First of all, and from a finance point of view, what exactly is infrastructure? Infrastructure has a few very special principles and characteristics which distinguishes it from other asset classes. First of all, it's usually designed to serve basic population needs. People need it, society depends on it, and, fortunately, it doesn't go out of style. Then, infrastructure projects are long-term by nature. We're talking decades, not fiscal quarters. They need to provide a stable and predictable cash flows, which is why these projects are often considered, well, slightly boring, but extremely safe for lenders and investors. Then, in many infrastructure projects, revenues are indexed on inflation. Indexing a project's revenues in project finance means adjusting income over time based on inflation or another reference index. Over several decades, inflation can quietly eat away at revenues like a very patient financial termite. With indexation, revenues, tariffs, or fees earned by the project automatically increase according to a formula, often CPI-linked, ensuring the project can at least cover operating costs and even provide comfort for the cash flows generation, debt repayment, and keep investors smiling. Another interesting aspect of infrastructure projects is that their performance is generally uncorrelated with traditional financial markets. While stock prices rise and fall with economic cycles, infrastructure revenues tend to remain stable. People still need electricity, water, transport, and digital connectivity, no matter how the financial markets are evolving. This stability is precisely what makes infrastructure so attractive. It behaves differently from most asset classes, offering long-term, predictable returns even when financial markets get a little dramatic. Another key point is that barriers to entry are high. You can't just decide to build a highway tomorrow. There's enormous capital expenditure, regulatory hurdles, and countless approvals to navigate. In project finance, a sponsor is the company or group behind a project, the one that initiates it, invests equity, and drives it from concept to completion. They're essentially the project's champion, taking the risk, coordinating stakeholders, and ensuring it gets built, while hoping the returns justify the effort. Think of them as the captain of the ship. They don't always steer every wave, but the voyage depends on their vision and commitment. In project finance, for each infrastructure asset, a dedicated company called SPV, for Special Purpose Vehicle, is usually created to hold the assets. Moreover, non-recourse financing structures are usually put in place. This means that if the project runs into trouble or defaults, the other project's parties, such as the lenders, cannot turn to the sponsors and claim their personal assets. The risk stays with the project, and only the project. It's a neat way to isolate risk, though it also means everyone involved in it, and especially the project's lenders and investors, need to be very confident in the project's cash flows and contracts. So, in essence, project finance is a way to fund these colossal, long-term essential projects in a structured, predictable, and risk-managed way. Now that we understand the main characteristics of project finance, let's look at who actually builds and operates infrastructure and who pays for it. On one side, we have public initiatives for essential services. These are projects like hospitals, jails, roads, or police stations, often delivered through what we call public-private partnerships, or PPPs. The public entities ultimately bear the cost, meaning taxpayers fund it, while private partners may help with construction or operation. It's all about ensuring essential services are available to society, not necessarily about making a profit. After all, hospitals aren't exactly Wall Street's favorite investment. Then there are the concessions. Here, mainly for infrastructures that generate revenues paid by its users, like highways, swimming pools, or public transport lines, with those assets being operated by a private company. Unlike a PPP, the private operator is fully responsible for the financial performance. They collect tolls or fees and bear the operational risk. It's a way for public services to leverage private efficiency while still serving the community. In both cases, whether we're speaking about a public-private partnership or a concession, everything usually begins with a tender. The public entity sets out its needs, the type of infrastructure, its capacity, environmental requirements, the expected performance, essentially a very detailed wish list. Then come the bidders, the sponsors, construction companies, investment funds, specialized developers. Each of them prepares a proposal outlining how they would design, build, operate, and maintain the infrastructure. They present the technical characteristics, the construction cost, the timeline. After comparing all these proposals, the public entity selects a winner. And for that winner, the prize is not a shiny trophy, but something far more valuable: the exclusive right to design, build, operate, and maintain the infrastructure for 10, 20, 30, sometimes even 40 years or more. This long-term commitment is what gives the project the visibility and legal certainty needed to approach banks, because without that contract in hand, financing a multi-million or multi-billion euro infrastructure project would be a bit like trying to get a mortgage without proving you have a house. But with the contract secured, the winner can finally match the project finance principles and fundamentals and go to the banks in order to raise the debt required to cover construction and investment costs. And the project can truly begin. Finally, we have a whole other category of infrastructure, coming more from private initiatives, even though they still provide an essential service. These include sectors such as energy, with wind farms or solar plants, for example, or telecoms, with data centers, fiber networks, or telecom towers. In these projects, private investors play an even bigger role. Alongside traditional project finance debt provided by banks, you'll also find private capital funds, infrastructure funds, private equity, pension funds putting in significant equity. And of course, they expect a return. In this context, project finance becomes a tool to structure everything properly. It allocates risk, return, and responsibility in a way that makes the project attractive, not only to lenders, but also to these equity investors. Because when you're asking people to commit millions or billions, clarity is not optional. Even private investments must follow the exact same principles we've discussed. Banks and investors will only commit if the project offers clear visibility on its future revenues. This often means securing long-term contracts with consumers, utilities, or other companies, essentially proving that the money will indeed show up. On top of that, the development must be fully completed before financing can happen. Construction and maintenance contracts must be signed, the land secured, environmental and public permits obtained, everything neatly packaged. Only then does the project truly meet the standards of project finance. In short, whether public or private, profitability always comes down to the same logic. long-term visibility, robust contracts, and a structure that makes everyone sleep a little better at night. Of course, no discussion about project finance is complete without talking about lenders and banks, the institutions that make these massive projects possible. Banks don't just hand over tens, hundreds of millions, or even billions and hope for the best. In project finance, they rely on very specific principles. First, remember the characteristics of infrastructure projects. They are long-term, serve basic population needs, have stable and predictable cash flows, and often benefit from inflation-linked revenue streams. They also require enormous capital expenditure, face high barriers to entry, and are usually structured through an SPV, non-recourse. These characteristics make cash flows predictable over decades, a crucial requirement for banks. Predictable cash flows allow them to build financial models that forecast revenue, operational costs, and debt service obligations. Using these models, banks calculate key metrics such as the debt service coverage ratio, DSCR. Essentially, the ability of the project's cash flow to cover debt payments. From this, they determine how much money can safely be lent without taking on undue risk. But banks don't stop there. They follow internal guidelines to align interests between lenders, sponsors, and investors, and ensure a satisfactory risk management. In short, banks in project finance are not just financiers, they are guardians of structure, risk, and alignment, ensuring that billions are deployed safely while keeping projects viable over decades. Now, don't imagine that banks just jump into these billion-dollar ventures alone with the sponsors. No, they bring along a whole entourage of other actors, each with their own expertise, to make sure the ship doesn't sink before it leaves the dock. Indeed, so far, we've explored the main principles of project finance and how infrastructure can be structured. But behind every project, there's a cast of characters far more diverse than you might think. In our next video, we'll meet the main actors of project finance. There are the developers, the visionaries who dream up projects and get the ball rolling, the independent power producers, or IPP, who specialize in generating energy and turning it into cash flow. Investors, including private equity funds, who provide the capital and expect a return over decades. Financiers, like banks and private debt funds, who structure the loans, manage risks, and ensure the money is available at the right time. And of course, the advisors, legal, technical, insurance, modeling, commercial, essentially the experts who make sure nothing blows up, contracts hold, and the numbers actually work. In the next video, we'll go behind the scenes and see how these actors interact, negotiate, and make these colossal projects possible, often without anyone noticing, except perhaps the occasional traffic jam or spinning wind turbine. So make sure you don't miss it, because project finance is not just about numbers. It's about people, decisions, and a little bit of controlled chaos. If you've enjoyed this introduction to the world of project finance, make sure to subscribe so you don't miss the next episodes. And by the way, have a quick look at the description below. I've added a couple of useful bits you might find helpful. We'll be diving deeper into the actors, the contracts, the risks, the modeling, and everything that keeps this industry running behind the scenes. And if you know someone who might enjoy, or desperately need, a clearer view of how infrastructure really gets financed, feel free to share this video with them. There's much more to uncover, and trust me, it only gets more interesting from here.